Hi, I'm Jonathan Aceves, Maybomb Commercial, where we help business leaders make wise commercial real estate decisions. Today we're going to be talking about 1031 exchanges and calculating capital gains. Today we're going to be talking about capital gains, 1031 exchanges. So the question, how do you calculate your capital gains and determine whether a 1031 exchange even makes sense? First, I have a story. I've got a business acquaintance who has become a client. Before we started working together, he sold a building that he'd owned for a long time. He operated a business out of it, and somebody made him a very strong offer, he thought. He didn't talk to an accountant. He didn't talk to an attorney. He didn't talk to a commercial real estate broker to review the transaction, which we would always recommend. He closed on the sale. And when he sat down, probably 6 months later to prepare his taxes, he learned that he was going to be responsible for over $300,000 in taxes. That means he lost nearly $90,000 on the deal. So how do you keep that from happening to you or somebody you love? Well, first you need to learn a little bit about capital gains. First of all, I want to disclose that I'm not an accountant. We strongly recommend having a relationship with a great CPA. If you don't know one, give us a call. We can recommend a few. And I don't mean somebody who prepares taxes, somebody who sits at the Walmart and fills out 1040s. We mean people who regularly consult and advise on people selling commercial real estate. Someone like that can compute your basis quite easily. And here are the formulas. And so in commercial real estate, we usually work with CPAs who prepare this information for their clients. But we've got the worksheets, and we'll make it available on the blog so that you can do this yourself. So here are the formulas. So the first step is to calculate your basis. And so this original basis, so let's say you had a property, and I'm actually going to use a transaction that we did. We worked with the guys at Cherry Beckert on this transaction as an apartment complex. So on this transaction, this owner paid $750,000 for a property. I think this was 20 years ago. And over those 20 years, they took $345,000, 509 in capital, in cost recovery. So that's depreciation right here. So the formula is you take your original basis, $750,000, plus your capital additions. This would be improvements, roofs, things that you're investing in the property that are going to be improvements to the property, and they didn't claim any, which and then we've got the depreciation, which is that $345,000, and then basis and partial sale. That's if you were like going to break off a portion of the property or sell a portion of it. They did not do that. So their adjusted basis in this property was $406,000. Excuse the math, I rounded. So then we calculate the gain. So once we've got this basis, we kind of know what we're working with. We go over here to calculate what your actual capital gain is. And so in this one, we take a price of $1,333,000, and then we take the cost of sale. Cost of sale would be any fees to transact, usually brokerage commissions, legal fees, maybe surveys, anything else like phase ones, anything like that. But in this one, it's going to be about $66,000. Their adjusted basis comes from here. So they got $406,000. Basis and partial sale, they've not done that. So then their gain on this deal is $857,000. So of the $1.3 million transaction, we're talking about an $850,000 gain. Now, they're going to pay taxes on the cost recovery, which is the depreciation that they've taken over those years at a given percentage, 25%. And then they're going to pay taxes on the capital gain, on the difference there at 20%. And that's so that that cost recovery is right here. So that goes here. That is $345,000, which gives them a $512,000 gain from appreciation. That means that this gain right here is due solely to the increase in the property value. Now, this is the amount of cost recovery they've taken over those years, and they're going to pay they're going to pay whatever $70,000 in taxes on the cost recovery, and they're going to pay $128,000 in taxes on the appreciation. That's it. We'll put that on a simple spreadsheet on the blog. You can download it. Again, we recommend having a CPA. Please reach out to us if you don't have one. We can give you a few recommendations. If you're considering selling a property and want to talk about your 1031 exchange, we're happy to sit down and review your transaction. Thanks for watching. Please like and share. Please comment on this video. We'd love to hear from you, and hope you have a great day. Thanks.